In this video, I'm going to discuss liquidity and solvency ratios. What do the companies that you see here, as well as the one individual shown here, have in common? They've all declared bankruptcy. Bankruptcy results from the inability of a company or a person to pay its bills. At some point, the lenders demand that the assets get sold for cash that can be returned to them. As I mentioned in the last video on profitability, lenders or debt holders are more concerned with the likelihood of repayment than profitability. The likelihood of repayment is analyzed in terms of liquidity and solvency. Let's start with liquidity. Liquidity is the ability to meet short-term obligations or to repay short-term debts. Again, in accounting, we measure short-term as being less than or equal to 1 year. This differs from solvency. Solvency is the ability to meet long-term obligations. Liquidity ratios help us measure a company's short-term financial health. Higher liquidity ratios indicate stronger financial health. We are going to look at 4 different measures of liquidity, and 3 of the 4 are very similar, and we'll go through why we use each one of them. The first measure of liquidity is not actually a ratio at all. It is simply a number. I'm sure you've heard this term before, working capital. Working capital is equal to the difference between a company's current assets and its current liabilities. So just a few bullet points on this. This is not a ratio, but a dollar amount. We typically expect it to be greater than 0. That is, current assets should typically be higher or at least equal to current liabilities. The higher the working capital, the more liquid the company is. And let's just take a look. Let's start with a GAAP's balance sheet. Let's take a look at what's behind the working capital. So if we look at GAAP, we see their current assets. Current assets consist of cash and inventory, primarily, simply cash and inventory. And current liabilities consist of long-term debt that is due within the next 12 months, past next year after the balance sheet date, accounts payable, accrued expenses, and other current liabilities. Remember, what this relates to is all those other operating payables, salaries payable, interest payable, all of those other small payables due to operations are lumped together here. So what is the company going to use to pay off? Oh, actually, the current maturity of debt, current portion of the long-term debt is 0. So it's the accounts payable and accrued expenses primarily. And what is the company going to use to get rid of or eliminate those current liabilities? It's going to use cash. Should the company at any point have enough cash to pay off all of these liabilities? Probably not, because other current assets, by definition, should be converted to cash used up in operations within the next year. So what's going to happen to this inventory? This inventory will get sold, and it'll probably still be sold on credit, and then that turned into accounts receivable, and those accounts receivable will then be turned into cash. Companies doesn't want to have too much cash sitting around, because the investors would say, we want you doing something a little more productive with the capital that we've given to this company, rather than just having it sit in a savings account. But we don't want the company to have too little cash, because when we need to pay our suppliers, these accounts payable, when we need to pay our employees their salaries, the government their taxes, perhaps interest that's due, we want to make sure that we have enough cash on hand to pay those bills. What if we don't? What else could we use besides the inventory that gets sold and the cash? Well, we do not want to end up in a situation where the company is selling off its property and equipment in order to pay off its bills, because the company will not stay around too long. All right, so let's look at the working capital for GAAP. I've done that here. Working capital, current assets minus current liabilities. You can see here I've already done the math for that. We just simply take the current assets of 4,568, and from that we subtract current liabilities 2,461. We see that the number is positive. These numbers are in millions. So as far as that analysis goes, GAAP looks fine. We can compare the measure to the other two companies we've been analyzing, comparing GAAP to Urban Outfitters and American Eagle. I scroll down, I get to my liquidity ratios. Now you'll see that the number looks different here. The reason why, and I've included a footnote, GAP's financial statements are in millions, while Urban Outfitters and American Eagles are in thousands. So you'll see in this cell here, I've added a multiplier so that we're looking at the numbers on the same basis. Doesn't matter for any of our other measures because they are all ratios or comparisons, but this is the only dollar amount where we need to ensure that we have them in the same same format. All right, so what can we get by this? Well, because it's a dollar amount, we see that GAAP, which is much bigger, has much higher working capital. But that doesn't tell us much because GAAP is much bigger, so we want to also see some ratios. And that brings us to our first ratio liquidity measure, which is the current ratio. Current ratio is simply the current assets divided by current liabilities. It's the current ratio, so clearly you're going to have current something on the top and current something on the bottom. The question in your mind is which goes on top, the assets or the liabilities? Well, just remember A comes before L in the alphabet, so we put assets on top, liabilities on the bottom. This is just standard convention. There's really not any reason why this ratio couldn't be flipped and standard convention could be liabilities on the top and assets on the bottom, but this is just the way it's typically used. So let's analyze GAP's current ratio. You can see I've already worked it out here. I hope that you'll work it on your own. I've linked here current assets divided by current liabilities. Remember, these numbers are coming directly from the balance sheet. And we see that we can say this current ratio of 1.86 means that current assets are 1.86 times greater than current liabilities. Or another way of saying this would be that for every dollar of current liabilities, the company has $1.86 in current assets that can be used to pay off those current liabilities. Let's compare the current ratio across the three companies. And now, whereas we were worried about size with the working capital, here we don't have to worry about that because this is a ratio. So which company has the strongest financial health or financial liquidity as measured by the current ratio? This would be Urban Outfitters. Does that mean that Urban Outfitters is the best? We can't really say that. We don't know what the ideal current ratio is. We don't want the numbers to be too high. Why not? Well, investors say if you have too much tied up in current assets, either in cash or in inventory or in receivables, that inventory might become obsolete. Those receivables may never get collected, and that cash is probably earning about 0.5% tied up in a savings account. So put that cash into more productive uses than sitting as cash or as inventory or as receivables. I'm not saying that Urban Outfitters is too high. There's no perfect number for it to be. But what we definitely can say by this is that GAAP is the most risky, Urban Outfitters is the least risky, but none of them seem to show any signs of distress. All right, the next ratio that we are going to discuss is the quick ratio. And this is also called the acid test ratio. All right, so whereas the current ratio was current assets divided by current liabilities, this ratio is similar. Current liabilities are still our denominator, and our numerator is comprised of current assets, but it does not include all current assets. The quick ratio is going to include cash, marketable securities, if there are any. Remember, these are the short-term investments that the company has, highly liquid investments. And we include accounts receivable. So what are we not including here? This looks very similar to the current ratio, but what current assets are we not including in the quick ratio? Hopefully you've thought to yourself, well, it doesn't include inventory for companies like Gap, Urban Outfitters, and American Eagle. That's going to be a big one. Doesn't include inventory, and then it also doesn't include other current assets. Typically, we'll see a line called other current assets. We don't know what exactly it relates to, but it can be such things as prepaid insurance, prepaid rent, supplies, prepaid taxes. We'll just call this prepaid assets, including supplies. Why not? Why do we need another ratio similar to the current ratio, but that does not include inventory, prepaid assets, supplies, and so on? Well, if you're thinking about ability to pay bills, can you pay your bills in inventory? Can you pay your bills with a prepaid insurance contract? We're looking for what can quickly be converted into cash. And you might be saying, well, inventory eventually will be converted to cash, and accounts receivable will also be converted into cash. Why are we not including inventory, but we are including accounts receivable, which are just simply claims to cash in the future? Well, hopefully the accounts receivable will be collected very soon, whereas we can't be certain of when we're going to sell the inventory. Also, accounts receivable can be factored, so they can be sold to a bank, and we call that factoring. They can be sold or factored for quick cash. Again, because this is very similar to the current ratio, we want the higher, the safer the company, the safer its liquidity, and too high, and we might be concerned about why does this company have so much cash tied up in cash investments? Why isn't it doing investing that cash more profitably in its operations? Let's take a look at the quick ratio for Gap. So our quick ratio, we have cash, marketable securities, and accounts receivable. All right, so we have cash, and that's it. We are not including the inventory, we're not including the other current assets, and the company has no listed accounts receivable and no marketable securities. Does it mean that company doesn't have any accounts receivable? No. They're probably buried somewhere in other current assets, but what it does mean is that it's not a very big amount that it needed to be reported separately. Just for comparison, let's look at Urban Outfitters. Urban Outfitters quick ratio and see what their balance sheet looks like with current assets. Urban Outfitters has cash, has marketable securities, and has accounts receivable. So we're going to sum up these three items as the numerator, ignore the inventory, ignore prepaid expenses and other current assets, and compare that to total current liabilities. So for Urban Outfitters, we see that the quick ratio is significantly lower than its current ratio, whereas for Gap, we see no difference. Let's look at all three companies together. And we see that just like with the current ratio, quick ratio, Gap is the lowest. Urban Outfitters has the highest, so we would say that Urban Outfitters is the most liquid according to the quick ratio. American Eagle is in between. Our fourth measure of liquidity is the cash ratio. And you're going to see a pattern here. We still have current liabilities as the denominator, but now what is going to be on our numerator? Cash and marketable securities. This is the most stringent or most conservative ratio. It also excludes everything that the quick ratio excludes, but it also excludes accounts receivable from the numerator. Why is that? Well, what's the purpose of the cash? To be used to pay off bills. What is the purpose of marketable securities? Excess cash, simply invested to earn a higher return than a savings account. We don't want to have to sell off our accounts receivable. We know that if we do factor them, it's going to come at a cost to the company. There's going to be a fee that's paid. So this is just simply the cash that's laying around for purposes of paying bills. And so that cash ratio tells us if we don't have to make any other changes, how does our cash and short-term investments compare to our current liabilities? So let's look at the measure for GAAP. My ratio analysis here, my cash ratio. Well, GAAP, remember, has no marketable securities, and they didn't report any accounts receivable. So we're not going to learn a whole lot by looking at GAP's quick ratio versus cash ratio. It's the same. So let's go to Urban Outfitters. And we see, so the quick ratio ignored the inventory and prepaid, so we see a decrease from the current ratio. And now when we go from the quick ratio to the cash ratio, we are leaving out the accounts receivable. We're including simply the cash and marketable securities. So let me delete my notes from earlier. We have cash, we have marketable securities. We are not including accounts receivable. We don't know when we're going to collect them. We don't want to factor or sell them. We're not including inventory or prepaid expenses. We're comparing the sum of these two items to our bills that are coming due and getting our answer of 1.24. So our cash that's lying around and able to be used at any time is 1.24 times greater than company's current liabilities. That indicates quite a bit of safety. We don't want these numbers to be too high, again, because that could mean too much cash is not being used in operations, but just sitting out idly. And when we look at the cash ratio across the three companies, we see results that are very similar to what we saw with the quick ratio. GAAP has the lowest. This is not necessarily bad, but it's the lowest compared to the other two companies. And Urban Outfitters has the highest or most liquid cash ratio. Let's move along now to solvency. So if liquidity is the company's ability to meet its short-term obligations, solvency All right, these are going to be a little bit messy, but solvency is the company's ability to meet long-term obligations or debts. So you notice that when we looked at liquidity and we were looking at current assets and current liabilities, we are focused on the company's operations, selling inventory, getting receivables, collecting those receivables for cash, paying for the inventory, paying the employees, those day-to-day activities. Solvency is looking at long-term. And so what do we measure? What do we use when we're trying to measure long-term cash adequacy? We are going to look at three ratios here. One is the debt-to-equity ratio. This is a pretty easy one to remember because it tells you what it's comparing. One thing you do need to remember is, what is debt? Are we looking for simply long-term debt, long-term loans, or are we using total liabilities? Well, the CPA exam and most analysts, not all though, use total liabilities as that measure of debt. Total liabilities divided by total stockholders' equity. So remember in some of our earlier, and when we were looking at some of our profitability measures, we were using average numbers from the balance sheet. We were creating a separate column to find the average of assets. And here you see we're using just simply total or ending. We're not using averages. You might be wondering why that is. Well, when we did take an average, it was always because the numerator was an income statement account, sales or net income that covered a period of time, a year. And using the ending balance, let's say we were looking at income over stockholders' equity, using an ending balance of equity might not be the best when income covered an entire year. But now when we're using simply balance sheet measures, we're taking the ending balances only. We're not worried about comparing 1 year's worth of one item and one point in time in another. These are both ending balances at one point in time. So what does the debt to equity ratio or total liabilities compared to total stockholders' equity tell us? This tells us about a company's leverage. Or the amount of debt used to finance assets compared to the amount of equity used to finance assets. Remember that most basic balance sheet. We have our assets on one side, and then on the other side is how we finance those assets. It's some portion of debt or liabilities and equity. And it might be a small portion of debt, and it might be a huge portion of debt. That is up to the company to decide, the owners to decide. Typically, the stockholders say use as much debt as possible as long as you can use these assets to earn returns. This is what our assets are doing. We're using our assets to drive sales. With those sales come expenses, and what remains is the net income. As long as that return on these assets is greater than the debt, the common stockholders say, we don't want to put in a lot, just use the debt to finance. But what do the debt holders say? The debt holders say, don't use too much debt because we want to be sure that we're going to be repaid. So high debt to equity ratios indicate high risk of bankruptcy. And what is high? And there's no one way to measure what a high debt to equity ratio is. If we really look at, well, the lenders will know. And typically a lender will have an agreement or a debt covenant with the company that says your debt to equity ratio cannot go higher than a certain amount. And if it does, you will be forced to not, will demand repayment. Or you'll have to sell off some assets or raise cash by issuing more stock in order to change your debt to equity ratio, because they're concerned, those debt holders, the lenders, are concerned about repayment. Remember, debt must be repaid. Equity, common stock, does not have to get repaid. That does not have to ever go back as dividends to those stockholders. The debt does need to be repaid legally. All right, so let's look at debt to equity ratios let's start with GAAP. Here's our debt to equity ratio. So you can see I've worked it out here, total liabilities, and I can see from this formula here they didn't give me one line item for total liabilities, so I had to do the calculation current liabilities plus long-term debt, plus, oh, actually just take the current plus the long-term, and that gave me my total liabilities, divide that by the total common stockholders' equity. Okay, so we see that liabilities are 1.54 times the size of stockholders' equity. How does that compare with our other two companies? Oh, we see that GAP's debt to equity ratio is much higher than Urban Outfitters or American Eagle. This should sound familiar. Remember when we looked at financial leverage? And when we did our analysis and profitability, we said that's actually how GAP is doing better than, was it American Eagle, I believe, had higher net profit margin and higher asset turnover. But we said that GAP was able to have a higher return on common equity because it's taking advantage of debt financing and earning a higher return than it's paying on that debt. All right, the next ratio we're going to look at is the debt ratio, and that's just simply a different perspective than the debt to equity ratio, but very similar. Debt to asset ratio. Okay, listen very, very closely as I explain the calculation for our debt to asset ratio, because I don't want you to be confused. We are going to take our total debt or total liabilities and divide it by, make sure you're not distracted right now, total assets. So that one is very straightforward. Again, we're not using averages, we're simply using ending balances. This is another indicator of financial leverage, just like the debt to equity ratio. It just simply takes a different point of view. Let's look at the total liabilities as they compare to assets. So liabilities compared to assets rather than how the liabilities compare to equity. And again, higher ratios indicate higher risk. All right, so let's look at GAP's debt to asset ratio. We see that liabilities are 61% of assets, and we can see that the difference, so 1 minus 0.61 or 0.39, is the financing of the assets with stockholders' equity. Let's compare this to our other companies. We can see that the debt to asset ratio for Urban Outfitters and American Eagle is about half of that of GAP, which is no surprise given the financial leverage we calculated and the debt to equity ratio that we used. Our last measure of solvency is called times interest earned. And this is also called the interest coverage ratio. They mean the exact same thing. Times interest earned or interest coverage. So we are saying how many times greater than our interest expense, because remember, what are the debt holders interested in? They're interested in two things: repayment, and what do you have to use to repay our debts? Use our assets, or compare the method of financing, compare the liabilities to the equity. We care about repayment, but we also care about, can you pay us those periodic interest payments? So what are we using to pay the periodic interest payments? For some reason, we're not including taxes here. So rather than looking at net income, remember that this numerator is operating income, income before interest and taxes. Operating income, also known as EBIT, earnings before interest and taxes. How many times greater is that operating income, which will be used to pay off interest expense? How many times greater is that operating income than the interest expense? Certainly this should be over 1, but it should be well over 1 because you also need to cover taxes, not just the I, but also the T. So it has to be clearly well over 1, enough to cover the taxes as well. The higher So let's see, indicates the number of times that operating income exceeds interest expense. Because again, debt holders care a lot about getting those interest payments. Remember, the debt holders are less concerned about profits than they are about receiving interest payments and repayment of principal. This measure helps debt holders evaluate the company's ability to make those interest payments. The higher the interest coverage, or times interest earned, the safer the company. Or in other words, the higher the times interest earned, the higher the solvency. All right, so let's look at our solvency, at our times interest earned calculations for GAAP. All right, so we're linking here to operating profit, or EBIT, divided by interest expense. So now we no longer need the balance sheet as we did with our other two measures. We're going to look at the income statement. Ignore my information here that we used for profitability. We are looking at how does operating income here in B7 compared to interest expense. And we see that it's many, many, many times greater. Our calculation shows us that it's about 20 times greater. And so that gives us some comfort. But we don't know exactly what the perfect number is. Let's compare it to the competitors. Times interest earned for GAAP, we said was about 20. American Eagle is just about the same. You'll notice it says here for Urban Outfitters that it's not applicable. Let's see why. Times interest earned for Urban Outfitters, I need to go to the income statement. And what do I see in the income statement? Remember, we want operating income. We have that here. Here's our operating income. But what is interest expense? It's not. It's interest income. It's a negative expense. So it would make no sense to say how many times greater income is, or that operating income is greater than interest income. Interest income is a positive thing. It is adding to the shareholder's wealth. There's a prop to income. There's no risk there, so that wouldn't give us any meaning if we had a negative times interest earned. So we know that if there is no interest expense, or the net interest expense is actually interest income, we just cannot interpret, or we can't even do the calculation for Urban Outfitters. So what is the debt holder's perspective? The debt holders are happy. Company has debt. Debt holders say this is very, very safe because they don't have a net interest expense. They can always use the interest received on their investments to pay the interest that their company incurs on its debt. All right, so that is it for our calculations for profitability, liquidity, and solvency. But before we conclude this video, we're going to look at a couple of practice questions. I'm going to start with a true or false question, and for each of these, be sure to pause after the statement is read so that you can think through your answer rather than simply waiting for me to walk you through it. All right, true or false? It is possible for a company to have a quick ratio that is greater than its current ratio. Pause here, take a moment to think about this. The answer is false. Remember, as we went through our liquidity ratios, they get more, starting with the ratios current ratio down the quick ratio to the cash ratio. Each one, the denominator stays the same, but that numerator gets smaller and smaller, or in other words, more conservative of what we have that we can use in order to cover our current liabilities. So our cash ratio must also be smaller, always be smaller than our quick ratio and the current ratio. All right, next one. True or false? The cash ratio differs from the quick ratio because the cash ratio excludes inventory in the numerator. Pause here so you can think this through and come up with your own answer. The answer to this statement is also false. It is true that the cash ratio does exclude inventory in the numerator, but that's not what makes it different from the quick ratio. What makes the cash ratio different from the quick ratio is the fact that it excludes accounts receivable. Both the quick ratio and the cash ratio exclude inventory, so they are the same in that regard. All right, here's a multiple choice question. If a company spends cash to pay a long-term liability, what will happen to its current ratio? Will it A, increase, B, decrease, or C, remain the same? Pause here so you can think this through and come up with what your answer is. The answer to this is B. The current ratio will decrease. So remember, think about the current ratio is current assets, current liabilities, and this goes back to you have to know how to classify cash, pretty straightforward here. So what happens if cash goes down? How does that affect our current assets? Current assets go down. If cash goes down, what happens to current liabilities? Nothing. And if long-term liabilities goes down, how does that affect our current assets? It doesn't. How does it affect our current liabilities? It does not. So the only thing that happens is that the denominator gets smaller, and therefore the entire current ratio would decrease. If our numerator gets smaller, the denominator stays the same, our current ratio would decrease. Next question, another multiple choice. If a company uses cash to purchase inventory, its current ratio will A, increase, B, decrease, or C, remain the same. Pause here to take a moment to think about this. Come up with your answer. All right, so again, the current ratio, current assets over current liabilities. So what happens when a company uses cash to purchase inventory? So cash causes the current assets to go down, but a current asset inventory would go up by the equal amounts. So the current assets are unchanged. Current liabilities are unchanged. So what happens when the company uses cash to purchase inventory, its current ratio will remain the same. And you can work examples like this by changing a current ratio. What would happen to the quick ratio? What would happen to working capital? And so on. Okay, if a company records an entry for salaries expense and salaries payable, so let's say it's the end of the month, employees will not be paid until next week, not in the current period, but we have used their services, so we need to record the expense and the fact that we owe them. What will happen to the current ratio? Will it A, increase, B, decrease, or C, remain the same? Pause now so that you can think this example through. Okay, the answer to this is B, the current ratio will decrease. What's going to happen to our current assets and our current liabilities? Well, nothing happens to the current assets. They are going to be unchanged. The company is not making the cash payment. What does it record that affects either current assets or current liabilities? It records the salaries payable. So the current liabilities will increase by the amount of the salaries payable. So if our numerator stays the same and our denominator gets larger, then our current ratio is going to decrease. B. 7, our last question. If a company spends cash to purchase a long-term asset, what will happen to its quick ratio? Will it A, increase, B, decrease, or C, remain the same? The answer to this, again, is decrease. So if the company spends cash, remember the quick ratio is cash plus marketable securities plus accounts receivable divided by the current liabilities. We can see here current liabilities are unchanged. Accounts receivable are unchanged, marketable securities are unchanged, but cash goes down. So our numerator decreases, our denominator is unchanged. And so our quick ratio is going to decrease, B. All right, in closing, hope this will make this whole video worthwhile. How do we know that Method Man from Wu-Tang Clan prefers strong liquidity? Take a moment, pause here, think about your answer before we return to the answer on the next slide. So before the semester started, you probably would have been surprised to know that this was one of my all-time favorite songs. But by this point, you perhaps may not be quite as surprised. Hope you enjoyed the video.